So good morning, everyone, and welcome to today's webinar on accounting for financial instruments and convertible notes. It's the first webinar back in the series this year. I think for some of you, you may have attended some of the webinars which took place last year. So we've been doing these for about a year now, and we've covered a variety of topics. I think we've done impairment, business combinations, and we've done some stuff on share-based payments as well. So look, this is kind of just the next kind of real section that I really wanted to focus on with everybody today. I think from our side, what we're seeing in the market at the moment is there is a lot of activity in the market post-COVID. In particular, we're seeing a lot of clients in our space which are considering or have done convertible notes in the past in order to raise capital, and we're also seeing a lot of our clients actually taking investments in other organizations. So I thought it would be a timely period to really kind of discuss accounting for these instruments, and basically just thought we'd spend a bit of time on that today. So thank you so much for joining everyone today. Just a bit of housekeeping. So it'll probably run for about 40 to 45 minutes today. I don't want to kind of just overdo everything. The key idea of this session is to give you kind of a high level understanding of these areas in terms of the accounting treatment, the required disclosures in the accounts. And if you do have kind of additional questions or specific kind of items which are kind of unique to your organization where you're from, then please feel free to send me an email. We can take it offline and potentially have a chat, and we may be able to help you or at least give you some advice that put you in the right direction. So if you do have any questions, though, we do have the Zoom chat feature, so you can just type something in, and if I can answer it straight away, I most certainly will. Okay, so the first thing I wanted to start really talking about today was financial assets. So the key standards, so there have been a couple of changes in the standards recently. We used to refer to AASB 139. It's been replaced with AASB 9 a couple of years ago. AASB 9, it was in the works for many years, probably about a decade. And it's kind of ironic that AASB 9 became effective at the same time as AASB 15 became effective. So you can see how many iterations and drafts the AASB went through. And if you do, have some spare time and you want to have a read through AASB 9, you will see it's a very extensive, the word I would use would be extensive and expansive, and has a significant amount of information in that to assist us in accounting for various financial instruments. AASB 132 is still active in terms of disclosures, and as we come on to disclosures further down the line of this presentation, I can show you some of the kind of key disclosures that you guys are going to need. So first slide up here, I just wanted to put a definition up of financial assets. Under accounting standards, a financial asset is defined as follows. So it can be cash, an equity instrument of another entity, or a contractual right to receive cash or another financial asset from another entity, or an exchange of assets and liabilities. I think from our side, obviously, cash is cash, an equity instrument. So effectively, if we're purchasing shares in another organization. And then when we come down to contractual rights, we're really talking about trade receivables here predominantly. And obviously, if we sell goods to somebody, we're expecting to receive cash or another financial asset in return for those goods. So these are kind of the key areas of focus when we're talking about financial assets and in terms of a definition. What we're really going to focus on today, though, is in terms of majority in number B there, so an equity instrument of another entity. I think it's pretty clear, how we account for cash and also how we account for trade receivables, although we will do a little bit on the expected credit loss provisions that the AASB 9 now has kind of changed the way we do provisioning for doubtful debts. So we will come on to that a little bit, but majority of our time will be spent on point B and point C1. Okay, next slide. So recognition of a financial asset. So we should be recording a financial asset in the statement of financial position when the entity becomes party to the contractual provisions of the instrument. So effectively, when we have a contractual right for that asset, we record it as a financial asset. You take the example of a term deposit. If we enter into that term deposit, the date that we enter into that term deposit with the bank becomes a date we recognize it. Likewise, with a trade receivable, the date that we can recognize the revenue there and send out an invoice to a customer is a date that we recognize it. Investment in shares is obviously the date that we purchase the shares. So it's quite, in terms of recognition, it's pretty straightforward in how we would kind of, in terms of a timeline of how we would recognize those. When we measure financial assets, so this is really coming on to the equity shares and how we value them. So there's a couple of ways that we measure these. So with regards to, say, cash, we obviously measure cash at its fair value. So we may have changes in our cash. For example, if we have a US dollar bank account, we have to remeasure that at each reporting date based on the movements in foreign exchange rates. So that would just be revalued for your FX gain or loss account in the P&L. With regards to financial assets, which tend to be equity investments, there are kind of a number of ways that you can do these. Now, the main kind of finding of the standard is that, you know, the majority of these gains and losses will go part through the P&L. There are a couple of exceptions as we kind of go through this standard and we work through the do's and don'ts of it. But ironically, in essence, the majority of the time you will revalue investments through the P&L. So say, for example, you buy some shares in, I don't know, Telstra. So if you buy your Telstra shares, you book them at, say, $10 a share. At the end of the reporting date, the share price is increased to $12. So you then increase the value of your investment, and you'd also take a gain through the profit and loss of that $2. So that would either go through other income or revenue, depending on the nature of your business. So that's how we'd account for the majority of these financial assets. There's a couple of exceptions here. So if you are in a financial services business whose objective is to effectively collect these cash flows and selling financial assets, then you are allowed to kind of value your investments through other comprehensive income, as was the case under AASB 139. There is also, as point 2 suggests there, an opportunity to effectively make an irrevocable election to continue along the old treatment, as we did under AASB 139. So just to give a recap for the people who may not have come across that in the past, under 139, if you had an available for sale financial asset, you could effectively take the gains and losses through other comprehensive income in equity, and effectively your gains and losses would go through other comprehensive income, and you would see your asset revaluation reserve increase. So under AASB 9 now, for historically what were available for sale assets, you now effectively have to take the gains and losses directly through the P&L, unless you make this irrevocable election at the time of purchase of your investment to effectively make the initial recognition measurement to continue to do it through OCI. So there is an opportunity there to do it how it was done in AASB 139. The difference is that the gain or loss would never be taken through the P&L. So in an instance where you then dispose of it, and I'll show you this in a couple of slides time in terms of the disclosure that we will have, you'll never have a gain or loss going through the P&L here. So effectively the gain or loss on sale will go directly into retained earnings or accumulated losses, and there won't be any kind of recycling effect going through the P&L. So it's kind of a professional judgment how you kind of want the users of your financial statements to view your business. I think from our side, what we tend to see is that the majority of people are actually making the irrevocable election. I think from a certain extent, a lot of the clients that we're working with, they don't have, it's not a core component of the business, this investment in financial assets. It's more just, oh, we've had an opportunity here and we've acted on that opportunity. So while they've made the irrevocable election, the main reason why that's been kind of done is so that it doesn't really distort the underlying business of your P&L. So say, for example, you're a tech startup and you make revenue on a SaaS basis, for example, and such like. You might not want a big gain, and you happen to take an investment in another organization. So if you do take that investment in the organization, you don't want that gain or loss each reporting period really affecting your underlying profit. You can kind of disclose it as a separate line item on the face of the P&L, so you can have a gains and losses from value of investments, and that's acceptable, but it's kind of really a personal preference and really a board decision. So it's just some things to bear in mind. So just want to come back to as well whether we do have the contractual terms to give rise to specific cash flows that are solely payments of principal and interest. The standard kind of basically defines this is assessing whether there are contractual terms, where the terms would be in line with basic lending terms, and there should be minimal exposure to risk and volatility. So hence, instruments such as convertible loans would fail the test, so they'd be linked to the movement in equity or commodity prices, which would have an increased volatility risk. So we're really talking about very low risk investments here when we're talking about these contractual cash flow characteristics. So just to kind of give you an example here, and a copy of these slides will be sent out later today, along with a recording of this presentation. So don't feel like you have to take down a copy of this table. So in terms of the contractual cash flow characteristics test, if we're passing that test, this is how we kind of get back to point 1 on the measurement of financial assets slide, and we can value our investments through OCI. So if we do pass that test, we can effectively, unless it's kind of, you know, the near held for trading, near-term profit-taking investments, we can choose, and you can see on the 3rd row there, we can go through fair value OCI. And I've never noticed there with recycling. So in this case, we do actually take our gains and losses back through the P&L when we sell. It's only when we make the open election, as noted in the 4th row there, that we don't do the recycling. And as you can see, if we fail the contractual characteristics test, so we do have a significant movement in the volatility of our investments, then we have to take the fair value gains through the profit and loss account. So as you can see there, with the changes in the standard, it's quite likely that most of the time you're going to have to take your gains through the P&L unless you make the irrevocable election. And I think that table really kind of cuts through a lot of the kind of there's a lot of words in AASB9 that kind of could really just have been summarized in this table. So it's something that you can use. And like you said, it's with terms of the contractual cash flow characteristics test, there is kind of an element of you know, judgment there as well. So I would, you know, if you are kind of in this situation where you're thinking about, can I put it through OCI with recycling as opposed to taking it through the P&L, it's probably best just to consult with somebody on the specific kind of situation there. So I wanted to come on to fair value now, and this is kind of an interesting topic because obviously there are numerous ways to look at fair value depending on the nature of the investment that you've got. Obviously for something like cash, it's pretty clear what the fair value is because it's the money in the bank. Likewise, if it's held in a different currency, it's pretty easy to revalue. Likewise with a trade receivable, effectively it's going to be whatever the receivables recognized in the books less you know, any provisions for doubtful debts. So AASB13 defines fair value as the price that would be received to sell an asset or pay to transfer a liability in orderly transaction between market participants at the measurement date. So this is how we kind of assess fair value. And I think some of you guys on the call probably will have come up against the level 1, heard of the level 1, level 2 and level 3 kind of assessments of how we measure fair value. And the real kind of implications here really come down to disclosure. So as we kind of go through there, so as I said, on initial recognition, most cases the transactional price will equal the fair value. But at each reporting date, we need to kind of select a valuation technique which is appropriate in this sort of particular circumstances, and they should be applied consistently. Management should consider the fair value hierarchy, which values investments in 3 levels. So when we initially buy an investment, chances are the transaction price is the fair value. Level 1 inputs are quoted market prices. So say, for example, we buy our Telstra shares, that's effectively a level 1 investment. Very easy to revalue at each reporting date. Effectively, you just work out how many shares you've got, and effectively from there go on and multiply out how the fair value based on the share price on the year-end date. So very straightforward. You disclose in the financials it's a level 1 investment, minimal other disclosures required. Level 2 is a little bit more kind of not so direct, not linked to direct quoted prices, but there are observable inputs for the liability or asset. So for example, quoted prices for similar assets or liabilities in active markets. So say, for example, you're a property, you own a number of land and buildings, you might have a land and building in there. You can go out and get an independent valuation of your land and building. They're probably going to compare your building to buildings in the area, or kind of of a similar size and similar condition, and that will kind of give you a valuation for kind of your building based on kind of similar transactions which have occurred. That kind of covers off point B there below. Other kind of items there in terms of interest rates and yield curves and quoted intervals. So this is kind of like if we're using kind of LIBOR rates to basically measure the value of our investment, or somewhere along those kind of lines, that would be classed as level 2. Again, with level 2, the disclosures aren't as onerous as level 3, and we'll come on to. There are a couple of additional disclosures. So you would quote about how you kind of came up with your valuation. So for example, in the case of the property business, you would obviously note that we've had an independent valuation performed, and that valuation was based on kind of similar assets and liabilities in the market, and that will kind of cover you off there from a disclosure perspective. So level 3 is a lot more a lot more significant requirements are required when you have a level 3 investment. So level 3 investments are effectively, we would buy a share in an unlisted investment. For example, a business which is not traded on any market, maybe it has minimal number of shareholders, it's hard to actively trade the shares, and so at each reporting day, it's quite difficult to put a valuation on that investment. And that might be because, they haven't done a capital raising recently. So we don't have an idea of what the shares are worth. And so we kind of get to our situation where we've got to value this investment, and I guess, how do we do it? So one of the things we tend to look at in valuing this investment, it would be kind of an NPV, discounted cash flow style analysis, or look at EBITDA multiples of the business. And obviously, if we're calculating at the end of a reporting period, say we bought an investment for $1 million, and we do our NPV, discounted cash flow with a terminal value, as I think we discussed, how it's pretty straightforward DCF model. For example, it comes out at a value of 750 as the net present value. We then take a hit of 250k in terms of our carrying value of that investment at year end. I think from our side, there are a lot more disclosures here, and I will kind of just come on to those shortly. But that's really, in essence, in terms of a level 3 investment, how we really look at that in the market, and that's basically how we need to go. So I will come back to the disclosures. I just want to briefly touch on expected credit losses. So this is quite a big change. From a lot of clients' perspective, the impact of this might not be material. It is really more driven for a financial services business. Say, for example, the large banks where they've got thousands of mortgages, and they're basically trying to look at the risk of default. So rather than kind of applying specific provisions over individual debts, you effectively look at the history of your debtor book over the past, however many years you deem appropriate, and effectively you'd work out as a percentage how how much as a percentage that you'd see as needing to be provided for based on historical bad debts. So say, for example, you had $1 million average debtor book of $1 million, and over the course of a year, you might have bad debts of say 1%. So in that case, you'd then book a provision of $10,000, for example. And you kind of look at the provisioning at each aging bucket. So say, for example, you've got if you look at your aging profile, you probably have 0 to 30, 30 to 60, 60 to 90 over 90 days. You'd probably apply a percentage to each aging bucket. Effectively, you'd obviously expect the percentage to be higher when you're getting to a point where your debtor hasn't paid over 90 days. So that's something to consider, and that will I'll show you that in the disclosure shortly, how that kind of comes about. I'm just going to look at the Q&A. Yes, there will be a recording of the session. It will be distributed hopefully this afternoon. So that's good. Okay, so that's expected credit losses. Again, just to reiterate, I think for a lot of clients in kind of the small medium space who aren't in financial services, it's probably negligible in terms of your bad debts. Certainly on the clients that I see, I don't have any clients with particular bad debt issues, and you can almost argue that this disclosure isn't really material to the accounts. So it's one thing to look at if you are experiencing kind of a lot of issues with bad debts, and you definitely need to kind of consider this model, and it's something that we can help you build as well if you need to. Okay. So I'm just want to go through some disclosures here now, and just to reinforce what I have said during the last kind of 15-20 minutes. Okay, so one of the first things that you're going to need to put in is when you do have kind of investments on the books, and talking about fair values, you need a critical accounting estimate in your financials. So this note in your financial statements effectively pulls out all the areas of judgment and estimates that management are making. So obviously, myself as an auditor and management themselves, they don't have a crystal ball. So we do need to kind of just call out the fact that there are some things which we are making judgments on. And one of the things here would be fair value, in particular the level 3 judgments. As you can see, if we are doing an MPV or an EBITDA multiple model, there are a number of judgmental areas there, such as the EBITDA multiple, such as the growth rate in your cash flows, which may or may not eventuate. But we just have to make sure that we explain that to the market and the users of the financial statements to say, look, to our best of our knowledge, this is what we're working with. But this note basically just calls that out. In terms of the financial investments, what I wanted just to focus on the disclosures for other comprehensive income. For the disclosures through P&L, it's quite straightforward. So effectively, you would just see your gain or loss going through above the line in the P&L, and your corresponding gain or loss increasing or decreasing the value of your asset. With regards to OCI, this note really would be similar whether it be through OCI or P&L. So effectively, we call this set of financial statements, we call out the number of shares that we've got in a specific entity there, and then we also do a movement reconciliation. So we look at the value last reporting period, and then we add in any new purchases. We look at our revaluation based on the share price. So this is actually a level 1 investment, and then any that we've sold during the period, and gets us back to our closing fair value. So it's more just a movement reconciliation, as you would see, in many other notes that you do within the financial statements, just to show to the users the kind of changes that have occurred during the period. I think just to kind of talk about when we have the irrevocable election, as I mentioned previously. So say, for example, we are fair valuing through the P&L, our gain or loss would go through above the 1082.069 there. Whereas in terms of if we are making that irrevocable election, it goes through as OCI. And you will note there, just below the other comprehensive income point, it says items that will not be reclassified to the profit and loss. So that just shows that if we do make this irrevocable election, we don't take any gains or losses through the P&L. As you can see there, I've just copied the statement of changes in equity. Just to avoid confusion, these are actually different sets of financials, because I just wanted to show you what happens when one actually gets disposed of. So you can see there we did have an amount in the asset revaluation reserve in the third column of 426,265, and that's just going straight into accumulated losses. If we were fair valuing through the P&L, it will be included on the second row within the 1082069. So that number will be different by 426,265, but because we've made that irrevocable election, it goes through separately. As you can see, there's no changes in equity on the last column, and it's just a pure reclass out of the reserve. You are allowed to leave the balance in the reserve. The accounting standards over equity say that you don't have to kind of tidy equity up if you don't want to. You can just leave it in the asset revaluation reserve indefinitely, but I think it's good housekeeping really just to shift gains and losses that when you do dispose of things into accumulated losses or retained earnings, just because it makes it a lot clearer what's actually in your asset revaluation reserve, and otherwise it can become kind of a bit of a black hole. So it's much easier to prove up to any stakeholders that ask, or your auditor even, what's actually made up of that balance. So just going on further to the fair value disclosures. So the financial assets, so here we talk about, this is basically just a copy from the previous slide, and we actually disclose this in the financial statements as well. So this is a standard disclosure that you guys can drop in. I wanted just to show you really the disclosures for a level 3 investment, just because they are a bit more intricated, as I was saying. This client in particular, this company in particular, doesn't have any level 1 or level 2, it only has level 3. So as you can see there, there's been quite a significant decline in the value of the investments in level 3. Effectively, when we do have level 3, we do have these additional disclosures that we need to put in. So this basically, this valuation was done using an EBITDA multiple. So the real area of judgment here is based on what EBITDA multiple should we use for this company. Obviously, we can calculate what the EBITDA was based on the results of that business, but just working out what the trading multiple should be, and we've put there's some disclosure there in the bullet point. We've also done a movement reconciliation that you're required to do. And the other thing about level 3 is, which is a bit unique, and I haven't mentioned it previously, is that you need to do sensitivity analysis as well. So if you can see there, if we change an EBITDA multiple of 1, it would decrease the fair value by another, or increase the fair value by another 107,000. So that's kind of the key areas that you need to really be focusing in on. If you do have level 3 investments. If you do have level 3 investments, one of the things you can do as well is, if you don't want to go through all this trouble yourself, you can go out and get an independent valuation. But for kind of smallish ones, you can probably kind of justify using reasonable assumptions what the value is kind of internally at a management level. Okay, so the last one I just wanted to talk about is the expected credit losses and how that would look. So as you can see, standard receivables disclosure at the top. So you've got your trade receivables, less any provisions for impairment, and then other bits and pieces which make up the receivables balance. The table below is really the bit I wanted to show you. And you can see there that this is kind of your gross carrying amount of the receivables. So you can see at the bottom of the third column of the second table, it's 4759, matches up to the bit at the top. And then the 131 matches up in the fifth column, matches up to the second row in the top table. So effectively what they've done there is they've said, okay, so if we've got debtors over 120 days, our expected credit loss is 1.13% based on our model at 2020. As you can see, they don't have any losses from 0 to 30, and 0.06 for 31 to 60. So that's really the table that you need to include if this is a material issue for you. So it's quite straightforward. The disclosure is quite straightforward. The real trickiness is obviously building the model and how far back you go. But I would just encourage you to discuss with your advisors or auditor about putting that together if required. All right, so that was everything I wanted to mention really on financial assets. I wanted to do the second half of the session on convertible notes. and a little bit just on financial liabilities at the start. So it's just a definition of a financial liability for you there. Obviously, the key examples of financial liabilities are trade and other payables, loans and borrowings, or convertible debt. So I think for trade and other payables and loans and borrowings, they're pretty straight. The accounting for them is pretty straightforward. Obviously, with an AP, you'll just go, credit your AP, debit expenses. Likewise, the loans and borrowings, you probably debit your cash and credit the liability. But with convertible debt, there is kind of a number of areas which I just wanted to kind of run by you. There are a number of issues that you kind of come up against, really, because obviously convertible debt has a potential to convert into your company's shares. So there are some areas just to kind of bear in mind. So there's just a definition here of a convertible note. It's a type of bond that the holder can convert into a specified number of shares of common stock in the issuing company or cash of equal value. Is a hybrid security with debt and equity-like features. So one of the things that you really kind of need to bear in mind here is that do we have a financial liability? Do we have equity? And do we have a hybrid? And then the final point to consider is, do we have a derivative on the conversion option that the note holder may have? So there are kind of more detailed diagrams out there on this and how to kind of determine whether you're an equity, liability, or a hybrid. But I think this one does 90% of the job. And I think if you do have something which is extremely bespoke, it would need probably its own diagram anyway. But I would say 90 to 95% of convertible notes I've looked at over my career would fit quite nicely into this diagram. So just to kind of take you guys through that, in the top left, so is there a contractual obligation to pay cash that the issuer cannot avoid? So majority of the cases there would be a contractual obligation to pay cash. Usually with these C notes, there's a coupon payment or at the end of the which they can't avoid. So that kind of gets you into the box on the right. If there's not, so sometimes the coupon just accrues onto the value of the liability, and then that all gets converted into shares potentially at the end. At the election of the note holder of the lender, or the borrower rather, my bad, sorry. One of the things to also note here is that with the convertible notes, who has the power to convert? So if the note holder can just say, I want to be paid in cash, then you're always going to be yes in that first question, because if the note holder can just ask for their money back, then the issuer can't avoid that. It's only in rare circumstances where there's no repayment required by the borrower to the lender, and everything is settled in shares. So it's quite rare to see that. So normally you'd end up in the box in the middle there. So does AASB 132 paragraph A to D apply? Now this relates to puttable financial instruments, and that's basically saying that we can mandatorily convert into equity at the lender's discretion. Very unlikely, again, for that to happen. Usually the company would keep that kind of benefit to their their advantage, and only allow conversion of equity to equity on their terms, whereas the note holder would usually be allowed to just ask for their money back if they want it. So in terms of, we get down to the next section there, does the instrument have any characteristics that are similar to equity? When we say no here, that usually comes down to whether there's a variable number of shares issued on conversion or a fixed number of shares. So some convertible notes, when people write the agreements, they might convert at a fixed conversion price of just say 10 cents a share. So you know when you're entering into the C note agreement how many shares you're going to get. So whereas with a variable number of shares, the number of shares you get might be based on a VWAP price over 30 days prior to conversion, in which case at the date you sign up to the C note agreement, you don't know how many shares you've got. So if you are in a position where that case is then you're going to be in the liability box. Whereas if you've got a fixed number of shares, there are an element that's similar to equity, so you'd be in the compound kind of area there. If we don't have to pay cash and we convert into a variable number of shares again, we get back ourselves into the same liability box again through virtue of that line that's going across the right there from the second box down to the liability. But if we're issuing a fixed number of shares and then there's no book value variable, then we would actually be in equity, but it's very rare to get a C note which is completely in equity. 99% of them will either be a compound or a liability. So if you do think you've got one at equity, I would encourage you just to double check that with somebody, because I haven't seen it too many times over my career, but they do exist, but majority of them will be liability and compound, and that's really driven by the fact that most of them will require a payment of cash in some component, and also most of them are variable number of shares. So I will probably say maybe 10 to 15% that I've seen a compound, and then 80 to 85% are liability. So I do have a bit of an example. I just wanted to show you, and I'm just going to close this now and come back to this spreadsheet. So I hope you can all see that. I'll make it a bit bigger just in case you can't see it that well. I just wanted to kind of just run you through just how it would work if you did have that kind of hybrid instrument. And effectively, I've got an example here for you where we basically work out the value of the equity component and the liability. So this note is just a random example, and it's for a principal of 500,000, a face value of 10 cents, and 5 million notes issued. Got a coupon of 10% paid semi-annually, and then a discount rate here of 15%. So how we calculate our equity component of this note is effectively we do an NPV calculation over the value of the note. This obviously is the most judgmental component of the kind of whole spreadsheet here, and that's why I've highlighted it in yellow. So effectively, you're going to need to work out what your discount rate should be. It depends based on your industry, what your cost of borrowing is, what your cost of equity is. So I've used 15 here as an arbitrary amount, but it's a much bigger discussion if you do actually have one of these. So it's something that you probably would need to consult on externally, either with your auditor or your advisor, just to kind of get to a consensus what the appropriate discount rate is there. So as you can see, this note started, for argument's sake, in May 18 and ends in November 2022. We've got contractual payments of 25k every 6 months, which is effectively 10% of the principal divided by 2, because we're paid semi-annually. And then effectively what we've done is we've calculated our value of our equity. So value of our liability. So we've come down here with a 422 as our liability, which is calculated basically as the discounted cash flow of all our coupon payments and then our principal and coupon in the final period. So then effectively, once we calculate our liability, the difference there is our equity amount. So on initial recognition, we book the journal here. So 500k debit cash, credit liability 422, and credit equity 77. We then kind of walk through the process, and then as we get to kind of the completion date in November 2022, we've got the final interest expense, the final liability unwind, and the final coupon payment offset by the repayment of cash. So effectively what we're doing is here, the liability unwind is bringing the value of the liability back to the total value of principal, so the 500k over the life of the note. So that then goes through the P&L as a finance charge, and it's included within the interest expense. So you can see here, the interest expense is going through the P&L. We're increasing our liability by 7,000 in this case for the period, and then we're also paying out our coupon in cash. So if we didn't have cash coupon payments, we would just be accruing this interest against the liability, and that would affect the coupon payments would effectively be increasing the value of the liability. We then this kind of comes down then and makes our journal entries at each reporting date based on kind of where we are in the timeline of the note. So this is a spreadsheet that I just kind of put together just as a high level. It could be done more accurately. For example, I've only done kind of biannual discounting, whereas if I'd done a number of days, it would be a more accurate calculation. But ultimately, this kind of gives you an idea of how we would calculate this if we do have a compound or hybrid instrument. So hopefully that helps. And if anyone wants to and has one of these instruments and needs any assistance, I'm happy to send this through to help you out. So I'll go back to the presentation. Okay, so just going on to embedded derivatives. So majority of embedded derivatives need to be valued by a specialist, and these are the three methods of valuing derivatives. So more often than not, Black-Scholes isn't really appropriate for doing this. So that means you then do tend to need the input of an expert. The Monte Carlo simulation is really the one that majority of people use when they do value an embedded derivative on a note. So effectively what an embedded derivative is here in this instance is that, say for example, the note holder can elect early conversion. There's a call option there within the convertible note arrangement which has some value. So we need to place a value on that. And how we value that is that we work out the value of the derivative, and then the difference would go to the host debt contract. So the assumptions used in the value of the embedded derivative are valuation date, obviously the date that the note's entered into, the face value, the spot price, the exercise price. So the spot price is the date on the notes issued. The exercise price is the potential conversion price. The life. The volatility is an interesting one, and that obviously can be calculated if you're listed in a listed company space quite easily based on kind of the daily trading data. Dividend yield likewise, and then also risk-free rate, which obviously these days is pretty minimal. So this is just a bit of a summary on accounting for C notes and how we kind of go about it. So the first thing, obviously, you go back to the table and you work out whether you've got a hybrid liability or equity. For convertible notes identified as liabilities and embedded derivative, the value of the embedded derivative should be calculated first with the residual amount being recorded at the host debt liability. The embedded derivative should be revalued at each reporting date, with any movement being recognised through the P&L. So we don't increase or decrease the liability as a result of movements in embedded derivative over the life of the note. The host debt contract under the amortized cost model should increase to the face value by maturity, with the increase in liability recorded as a finance charge for the P&L, and that was what I was showing to you on the spreadsheet before. Interest should be accrued against the liability unless settled in cash throughout the life of the instrument. And then the equity component never gets remeasured. So on initial recognition, once you determine your equity component, that's it. And then if you do end up issuing the shares, then that equity reserve would then transfer into share capital. Pre-IPO convertible notes, and this is a very interesting topic. We've kind of come to a view on this that pre-IPO convertible notes do not have embedded derivatives if they're classified as a financial liability. This is really down to our view that these notes don't meet the definition of a derivative under AASB13, as the financial instrument price has not been set and the value of the derivative is not changing to a response in the change in the financial instrument price, as the financial instrument price has not yet been determined. So when we enter into a pre-IPO convertible note, and a lot of people do this due to the fact that they need some seed capital raised prior to the IPO. If the note converts on the IPO date, then there's no embedded derivative because we don't have doesn't meet the definition of a derivative on the AASB9. Now this is different if your convertible note is issued, but it doesn't convert on IPO date. So say it converts 2 or 3 years after IPO, then you would need to assess it, and it's likely that a derivative would be in existence. But 90% of C notes which are issued pre-IPO tend to get converted on the IPO date into equity. So on that basis, we don't believe that a derivative exists, and that's our view of that matter. And I think it does make things a lot clearer and a lot more straightforward for users, management, and advisors as well. Just to finish off, just before we wrap up, I just wanted to show you a couple of convertible note disclosures. So this one here, so essentially the first thing we'd have to do in the notes is just disclose the key terms of the note, and when they expire, what the price was, whether they're kind of how many there are and the expense there. And as you can see for this one, there's a variable number of shares because we don't know how many shares are going to be converted. We then go on and we continue on talking about the fair value measurement. We've also kind of reconciled the liability. So our face value, we've had a few that have early converted, and then we've also got interest on the notes, which hasn't been paid out as at the reporting date. And then we've also then listed our assumptions. So in this case, we do have an embedded derivative there, and we've disclosed all the key terms of the note as part of the embedded derivative disclosures. So we've got our volatility there, our conversion, the share price, risk-free rate, fair value of the note, and fair value of the derivative, and then essentially that's everything that you need to include. So that was everything that I really wanted to cover today, and I think I have done it in about 45 minutes, which is good. I do really appreciate everyone who's on the line today. It's great to see so many of you on the line. I think if there are any topics that people are interested in learning about or discussing prior to 30 June, please feel free to email me. I do plan to do one or two more webinars before 30 June, I'm hoping. So if there are any specific topics that people would like, you can put it in the Q&A or the chat box now, or just send me an email privately, and I can certainly look into preparing something before June for you guys. Likewise, if you do have any convertible notes that you're looking to enter into or financial instruments before 30 June and you do need any advice, then we are here to help. So unless there's any questions, oh, something's gone in the chat box. Yep, so we will be sending out the presentation material today. And so really do take care, everybody. And yeah, all the best for the rest of next couple of months leading up to 30 June. Take care. See ya. Bye.